Good morning, everyone, and welcome to this month's edition of On Track. It's the 23rd of June as I record this Monday morning and just fresh off our investment committee meeting, which is the third Thursday every month. So last Thursday in Sydney. Before I dive in, just our general advice warning. This is designed for clients of McGregor Wealth Management, particularly those that use our care methodology and care portfolios. For all else, welcome to listen and take stuff from here, but please get advice before you act on anything we talk about here. So we're going to cover all this stuff today. It's fairly a narrow path of topics. It's in our face at the moment. It's all about Trump and Middle East and Israel. So we'll dive in on a little bit of that. The markets haven't reacted too much. In fact, they've bounced back from tariff stuff, but I'll talk about that when we get there. Right about now. So the key news for the month, share markets are pretty much back where they were to pre-January tariff highs. It's interesting the Israel-Iran war, and then I added this morning. Obviously over the weekend the US joined in with the mega bomb on Iran. Oil prices spike. The big question is what happens from here. You're watching the news, you can hear it. I'm not going to pretend to be a Middle East expert. I watch what the markets do in response to these things. It's interesting. The chart down the bottom left shows the oil price jumping up. It looks like a share market chart. So that chart also goes back to January. That's when the share market did peak. And oil price dropped as the tariff stuff was sort of resolved, and then it's bounced back up. The experts pretty much agree here that the oil price will probably drop if this thing settles down. If they keep fighting, it'll probably stay where it is. But the real wild card is if it slows down oil production, getting out of the Arabian Gulf. I'll talk through that in a minute. Hold that thought. Trump put his big, beautiful bill to Congress. He seems to be probably the only one that thinks it's a big, beautiful bill, hence the name. And it's all about perpetuating the tax cuts that he did put in first term and leaving them there. And there's various other bits and pieces in there, including some of the election promises, no tax on tips, and a few other things. It's not fixing US budget deficit issues. Some would say it exasperates those. It certainly keeps it in the status quo. And what we've talked about the last few months, potential for tariffs to fill up some of that revenue. We'll see where that goes in a minute. The Fed has put rates on hold again there. So at the start of the year, everyone was thinking rates were going to go down in the US, but they have not. Mainly because the Fed needs to know what's happening with tariffs, because tariffs do affect inflation, and they don't want to be dropping rates and then have to put them up again if they do need to stop inflation, if in fact that does come out. The tariffs were paused until July 9th, so that was 3 months. So we will find out on July 9th what the status is, whether there's an extension of that, whether there's any resolution. They're negotiating with 128 countries. So you can imagine the amount of work that's got to go into all that stuff. There's been a couple of announcements, but nothing too drastic. So we'll wait and see, but I don't expect too much there. The RBA did drop rates though by 0.25% down to 3.85. The black chart with the pink line there shows rates back to 2009. So we had those very low rates of COVID down to next to nothing, but we're kind of back in the zone we were after the GFC, when rates were pushed up to slow a booming economy down. Then they were dropped rapidly in response to the GFC, and then pushed up, and they were in that normalish range, of about 3 to 4%. So we've talked about where the new normal is going to be. It's very hard to tell in this environment, but we sort of work off that new normal as probably being around that 3 to 3.5%. So there is consensus that another two rate drops, that would bring it down to about 3.3, and that would seem to be about neutral for Australia right now. That'd be good news to anyone who's borrowing. Not so good news for anyone who's a term deposit investor. As we scan the rates down there, we can see that 3.85%. You can see that almost immediately reflects in the 90-day bank bill rate because it's a short-term cash rate. Obviously, 90 days is 3-month like term deposits. Has not really impacted. No, it has impacted a little bit, the 10-year government bond deal, but there's more going on around that than just what's happening in Australia. It's very much dependent on what's happening with Trump, tariffs, oils, etc. Sorry, just skipping ahead. Um, Aussie dollar still remaining moderately strong, in spite of all this. So it's actually gone up a little bit the last 3 months from about 63 cents to 65. Good news if you're traveling. CPI in Australia is fairly, yeah, we don't get the number out till next week in Australia, but so I've still got last numbers, but yeah, the headline number is absolutely within the band. That's why the RBA was comfortable dropping. US inflation is also at that level. They do target 2% rather than the 2.5% we target. But you would normally be expecting the US Fed to be dropping rates, except for the fact of the tariffs, etc. One of the wild cards for the markets is if Trump does go to war with Powell, who's the chair of the Fed. That is one of the black swan events if he all of a sudden sacked him or made him. But Trump's been he's insulting him in his tweets as he does to lots of people, but making no attempt apart from that to sort of influence. Powell does finish up next year, and Trump will get to appoint the successor. So the markets will be watching that appointment with interest. They will not want to see someone who's going to be a puppet. They want to see someone like Powell and Greenspan and the others before that who seem to be independent, which is a good thing. Mortgage rates, as I said, dropped. So we can see the cheapest rate out there dropped to about 5.5. The more typical one, so Macquarie is a good example, 5.74. So the banks immediately passed that all on. 1 year term deposits are still in the same zone, but of course 3-month term deposits have dropped. So portfolios to the end of May, it's been a good year. So ironically, in spite of having a V in the middle of it, it's a good year. You can see the performance numbers down the bottom here for various. So balance fund sitting at 12.15. That's looking good against similar industry funds I'm seeing at the moment at 7-8%. There's various reasons for that. So we've had a good year. You can see part of that driven by international equities, very strong. The active portfolio, extremely strong. We were weak on Aussie equities because our manager there has a value bias. That means he's very conservative, so he's holding a bit of cash. And that has cost us in that performance, but in the overall ecosystem, really good returns. And when you look over the 3, 5, 7, 10, they're good numbers that are exactly what we chase in terms of planning. Our goal, as always, is to be above average in performance, below average in fees, something we've consistently done for over those 10 years now. Now, we have put up at the meeting last Thursday, we did put the dial up to 10. That's exactly where it was in January. So it's back to where it was. We think the market's expensive. It's not crazy expensive. And how expensive it is going to be will depend on what happens with growth, what happens with all sorts of things around the geopolitical stuff, Trump tariffs, all the Middle East tensions, etc. It may prove to not be expensive, but we judge it on how we see it at the time. That just means we have a bit of caution. So we've been rebalancing and topping up reserves. We're happy for people to take profits if they've got money that's going to be needed. And we're back to averaging in for our new clients or people that have got new money to invest. We're back to averaging in over 6 to 12 months just to spread that out. So you can see on the right-hand corner of this is our 20-year chart. And I show this for two main reasons. One, to show that downturns of between 12 and 20% are very regular. So in this case, 7 of them in the last 20 years. We had 2 bigger downturns, of course, in terms of 50% from the GFC and then 36% from COVID. My arrows have been over whack. My apologies. I'll fix those for next month. And you can see the 14% Trump one. Or Trump tariff tantrum will probably end up calling that. So fear of global trade war, which is exactly what it was in Trump's first term. We had a fear of trade wars. But that gap is closed for now. We fully expect when we've got the dial at 10 and we've got lots of tensions going, we fully expect there may be other short-term drops like this one in succession over the next few years, but that doesn't take away that strong belief that we should be in the market in the long run, because it does climb that wall of worry. So the latest bit is all about, it's funny, the Israel's attack on Iran immediately took two things off the news. One was the US LA riots. They were pretty mild, really, and they wouldn't have got as much oxygen in terms of the media if it wasn't for a bit of quiet around this. And as soon as the Israel-Iran stuff happened, you're not seeing a whisper on the LA riots. I'm not sure what's happening myself, so that tells you the media stopped covering it. I assume it's gone away. And of course, then the big question was, would the US jump in? And they did on the weekend, and you may have seen Trump's announcements. So, like I said, I'm not going to attempt to interpret Middle East tensions. It's been going on for 2,000 years. The best brains in the world have never been able to solve it, so I'm not going to pretend I can. But what we can do is give you a narrative on what it means for markets. So, as I said, those oil prices have fluctuated due to potential supply disruptions. Note that word is potential at the moment. So this was an article, and apologies, this was from an oil analyst. So it's an oil analyst that studies the market. So and they said potential supply disruptions, but it is potential. At the moment, the oil is flowing. But look at this Strait of Hormuz. So you'll see on this map here, Iran sits at the sort of the bottom of Asia almost. And below it at the top of Africa, you've got Saudi Arabia, Qatar, and UAE, massive oil producing states. Now, for them to get their oil out without disruption, there's other ways, but they pretty much at the moment have tankers that go through the Persian Gulf and the Strait of Hormuz. Now, Iran has threatened for over 20 years, whenever there's a crisis like this, and this is not the first one, to block that Strait of Hormuz. Now, the US would not allow that to be blocked, and there's plenty of US warships in the region. It's always interesting looking on what Russia and China are doing as well, and there's certainly some Chinese warships in the region as well. So if there were some direct attacks on oil infrastructure, that would continue the price spikes. But if these don't materialize, as it says here, oil prices probably drop back. So they've spiked up on the potential of disruption. If there is no disruption, you would expect they drop back. Dropping oil prices had been good for inflation, so hopefully they come back, and hopefully the tariff stuff gets sorted, and that would likely lead to the Federal Reserve to drop rates, and all of that it's generally good for markets. In my exciting life, boring money segment, I'm trying to highlight here news that is affecting or potentially affecting investors that doesn't necessarily affect us because of our strategy around exciting life, boring money. So one of my things I analyze a lot is industry super funds. I do have some concerns over the big industry super funds. They are now the biggest funds in Australia. They are acting in some ways that display hubris, and the fact that they're the big end of town, and the fact that they've got a multi-term Labor government behind them to protect them from stuff. And there's been a lot of things, but this one was different. This was interesting. This is REST warning APRA. So REST and all the other big super funds have to report to APRA certain things. But they did warn APRA here that they had to watch their cash reserves, because the Trump tariff tantrums set global markets diving, and that pushed their members to switch retirement investments. Now, the reason I show this is, picture an industry super fund. Someone either jumps online and in a panic, they can immediately panic and move their investments from a balanced or growth fund down to cash. Almost impossible to do well. And by the time the market has dropped, it's too late to do things there. And then they invariably get back in after things have settled. So the fact that unadvised industry super fund members continue to make crazy decisions when there's uncertainty and turmoil, it never ceases to surprise me, but it always does surprise me, because we spend so much time talking about it and educating ourselves and educating all of our clients and advisors to avoid that. The stats never change. People still do silly stuff whenever there's volatility. So the fact that we don't puts us ahead of 90% of investors. So the bond market, you'll see it's squiggling across the top at the bottom two charts, stuck in a zone between 4 and 4.5% at the moment, waiting to see. And once again, I think if we got some clear air, you might see bond markets drop to 3.5%. But at the moment, every time it looks like it's coming down, other stuff comes up, tariffs, tensions, all the rest of it. So we'll see. And not much change to the yield curve from a month ago. Sorry, the yield curve dropped over the last month. The 10-year rates, not much change from a year ago, ironically now, but there's been a bit of movement in between. A lot of worry, just that concept that the market spends most of its time in worry, which we're quite clearly in at the moment. Every now and then we stop worrying, we have a boom, we haven't had a proper boom in the share markets since 2004 through to 2008. It will happen eventually, and the longer it goes on, I feel like booms only happen when everyone investing has forgotten about the last major downturn. It's why we believe watching history is so important. Understanding cycles is so important, because the key is if you know you're in a boom, you can be cautious. Doesn't mean you get out of a market, but it means you can be cautious and not make the mistakes that most people make in booms. And that psychology here is shown. That's all those major downturns, 9 over the last since 1900, all come back strongly. But it is that pendulum, and as I said, we've got the dial at a 10. Short-term focus. You've heard me talking about Trump now for pretty much 4 months straight, and even last year. So the focus now is pretty much Trump and Middle East. These things pass, and when you look back, they never seem as important as they did. This Middle East tension is it's. I'm not going to say it's not important, because it is, and clearly if things went awry, it wouldn't be pretty. But the media loves this. They jump on board. They go 24/7. This is how CNN invented the 24/7 news cycle back in the Gulf War #1, and they love trying to get people to keep the TV on. There's much better things to do or watch than the wars, etc. A quick summary of 5 minutes a day or a week or a month is enough there. And as many wise people I know say, if you can't control it, there's no point worrying about it, and control what you can. So behavioral bias response, I've thrown in herd instinct and got the cartoon there, the lemmings going over the cliff. So we saw this in the downturn April, May, where people sold. And then as it didn't look as bad, everything goes back up again. But that herd of investors, of fund managers, it's a big herd that over exaggerates the news. So because if you think about it, when something like a war breaks out here, it doesn't change how much you're spending on your groceries. It doesn't change your use on Google or Apple or your Amazon orders or anything else. It doesn't change them much, if at all. So that means the companies that you're invested in, which are all of those companies plus more, are still making the same amounts of money. Now, at the margin, there are things affected. As interest rates move and as tariffs come up, there's certainly been companies that have been more impacted by that. And even in a war, defense companies go up. But the bulk of the market is in areas where our spending continues, which is why the market's so obsessed with looking out for major recessions, because that does affect all companies. We're in a slowdown at the moment. Australian growth slowed to about 1.3%. US is flatlining as well, but we're not in a recession, and steady growth still means there's plenty of opportunities for good companies to make money. So the quiet achiever of the portfolio performance and outperformance is rebalancing. So it's just where, and so during that volatility of the last 2 months, we're able to rebalance both in the middle of it, so right down near the bottom. That means what we're doing there, picture shares are down, picture the V, shares are down. So we buy some more by selling some of our bonds, buying some more shares. And then when the rebound's completed, we do the exact opposite. We sell some shares and we buy some bonds. So these little profits come in from rebalancing, and the volatility actually delivers better profits from rebalancing than it does in a boring year where there's less chances to rebalance. So this is why volatility is our friend, and assuming we don't panic and all the rest of it that we talk about regularly. Let's have a look. So in May, Aussie share market up 4%. There's that V. Yeah, straight out, straight past where we were back to January. So quite incredible. Aussie shares done extremely well over the last 10 years. Not extremely well, I should say average, low inflation. So they've done that inflation plus 6 to 7, which is what we expect in the long run. 5 years is a bit distorted at the moment, 11.99%. 5 years is off the back of still in the COVID ditch. So you see the COVID ditch here in the middle of the bottom chart where markets went down 36% and then came back. So in June, we were halfway through the comeback. So as we finish that comeback, that 5 year return will start to subdue a little bit. But 1 year certainly been a good year, as has the last 3 years. So it's been a good year, a good 3 to 5 years to have ignored market noise, invest wisely, and just rebalance and do all the other things we talk about. There is a story in Commonwealth Bank. Commonwealth Bank is now 11.26 of the Australian market. It's trading on a price earnings ratio of 26. You can see here. That's almost, not quite, twice as much as National Bank and Westpac, and it is more than twice as much as ANZ. So that's the market saying it's twice as good. There's almost no analyst that thinks that. It's a weird conundrum that through a mixture of index funds and US fund managers looking to invest in Australia to diversify away from American weakness, it's holding Commonwealth Bank up. You would think that would reverse at some stage, whether it takes a month, a year, or a decade to reverse, who knows? If anyone was thinking of selling some Commonwealth Bank shares, the price is certainly well over what any analyst can justify at the moment. So it's quite, and it's gone up 44% in the last 12 months. So it's a classic, but and we don't hold it in the Australian share portfolio. That is partly why it's underperformed, a bit of cash and a bit of that. And you'd see the Commonwealth Bank has almost got the same price earnings ratio as CSL, which would have been unheard of 5 or 10 years ago. US shares, 5.73% for the month, and not quite back to where they were, but this chart is in Australian dollars and the Aussie dollar is a bit stronger. So in the US, it's almost back to where it were. The US S&P 500 is hit on 6,000. It was as high as about 6,1, 6,2. So it's not quite where it was, but less so because the Aussie dollar's gone up. So that weakens our return. But look at the 1, 3, 5, and 10 year returns, extremely solid to the point where $10,000, 10 years ago, reinvested is worth about 41,000 in US shares. And you can see, here's the price earnings ratios of some of the big tech companies who people say are expensive, but I'll just go back. Commonwealth Bank at 26.74 is more expensive than Apple. It's almost the same as Meta, which is Facebook, and it's not far off Microsoft, Nvidia, and Amazon, which are growing like crazy compared to Commonwealth Bank, which is profits are due to grow at about 1 to 2% over the next 3 years. It's a real aberration, CBA at the moment. And it may be an aberration for years. Maybe they'll grow stronger than analysts expect. Maybe it'll just flatline. Maybe it'll come back to earth. All those things are possible. Doesn't matter for us because we're investing through the indexes for the most part. But yeah, just an insight into how close it is to those high-growing companies. Global leaders, much of the same companies and much of the same pattern, 6.4% for the month. Great returns over the last 1, 3, 5, and 10 years, 10,000 to 41,000 again there. And we go to US small caps. US small caps have done it tough the last year. You can see 1% there. Once again, that's why we love diversification. We've had incredible returns on the leaders. The smaller end of the US market has lagged after having a phenomenal run up until a few years ago. Now, we fully expect, and this has been a beneficiary of a lot of the rebalancing we're doing, so we get to buy more. Had a good month, and this is where we expect as markets come back, the small caps. In if you look back over hundreds of years, small caps outperform large caps, but they do so with more volatility, which makes it an important part of the portfolio for the long run and for the diversification. Emerging markets, similar but different. It's had a good year, but an ordinary 5 to 10 years, but that's coming back quick. And that's why we've kept them in the portfolio, kept buying through rebalancing during all the downturns that it's had. Once again, this is partly due to the world looking outside the US as a result of the Trump tariffs. There's some amazing companies in here. So companies like Taiwan Semiconductor, Tencent, Alibaba, Samsung. Look at the price earnings ratios on those. Samsung, equivalent to Apple, trades at half as much. Now, some of the top three are China, so that's why they trade at lower price earnings multiples, just because of the political risk or a sovereign risk that China carries. But they're all cheaper than CBA. Gold, just spectacular. Flat for the month. It's flatlining a bit at the moment, but 44.8% for the last year. So an incredibly important part of the active portfolio. It's an alternative currency to the US dollar. So every time the US dollar looks like it wants to weaken, or if people are looking for an alternative, there's no other currencies really. So it does get down to gold and some of the other precious metals. We will continue to hold gold throughout. We don't while the US carries a decent level of debt and will be volatile, we're not considering taking profits here, and there's still potential room for gold to grow. I would point out for people that sometimes get over the top on gold, gold produces no income, so it's not part of a long-term strategy. This is part of the risk management within the portfolios. So that's the long-term strategy for this. If you had a pile of gold as your whole retirement portfolio, you have to sell it every now and then to live off because it produces no income. On to property and our model there of boom, bust, boring. Yeah, when you look at the averages, this is interesting. For the last 3 months across Australia, 1.3%, a bit higher in the regions at 1.6%, capital city 1.2%, and for 12 months, 3.3% for Australia on average, 2.6% the capital cities, a bit more in the regions, 5.3%. But averages, you've got to be very careful how you use averages. They're not good numbers. As you scan down the capital cities, you'll see a different story, not as wide as it has been, but in the last 3 months, the places to be would be Darwin, and Darwin's had a long period of suffering. We've got clients in Darwin and clients that have properties in Darwin, so it's nice to see it coming back into a half decent market. 4.3% regional South Australia, flowing on from the good growth that Adelaide's had over time. But on the bottom end, you've got Canberra, Hobart. Melbourne's coming back a little bit, but when you jump across to the right, the 12 months, you can see top performers, regional WA, regional SA, and they've benefited from Perth going up and South Australia going up. The flows, that's like, I'm often talking about ripples in the pond. The ripples start in places like Sydney and Melbourne, they go out to the other capital cities, and then they end up out in the regions as we get this flow on. But yeah, regional Victoria done nothing. Melbourne actually went backwards the last 12 months, as did Canberra. Regional Northern Territory actually backwards regional Northern Territory, in picture what that looks like. It's a very thin market, as in there's a whole lot of land, a whole lot of desert, and not a lot of towns and cities. But yeah, Darwin for the year about 3.9%, so not as much. You can see it's actually lost money except for the last quarter. So, and you can see from the next chart on the left here that convergence. This is the growth rate since COVID, or since May 20, just as COVID was in the middle of that ditch and prices spiked. Growth rates were phenomenal for a while there, up to 30%, then broadly dipped. But we see them all. And then there was this period for the last 2 years where we had Perth, Adelaide, Brisbane growing, Sydney in the middle, but Hobart, Melbourne, ACT all flat, and Darwin, and then they're converging back now and getting closer there. Rental yields across the country are low. You can see that pattern, 3.71. This is gross rental yields too. So any of you that own investment properties, actually all of you, whether you own investment properties or your own properties, you've seen how much insurance on Property's gone up in the last 3 to 5 years because of the cost of replacing the building in particular. So that just means higher premiums because of higher replacement cost. So by the time you take out rates, other taxes, body corporates, repairs, etc., the net rental yield on property is now probably closer to 2%. So that means the income you get, this is on average. There are some places that are clearly higher. You'll see the higher rents available in regional Northern Territory and Darwin. I wouldn't suggest chasing that. It comes with a lot of volatility. But even in the other places, the fours down to threes. Sydney, as always, is nearly always the lowest rental yields. But you take away those costs and you get down to 2 to 3% is the net rental yields. When we look at factors that drive property, one of the biggest ones is population growth. That just means we need more houses. The other big one is interest rates. So we've got interest rates falling and we've got population growing. Top right-hand chart, you can see that where we're at the moment, so about 1.6% as our population growth. That translates to the bottom right-hand chart, the blue line of about 450,000 new people. Now, some of that's from natural increase, call that births over deaths, the excess of births over deaths. Then you've got net migration, which is the difference between people coming in and people going out. Net migration back to the top there. You can see in COVID, all the temporary students and others left. That drove that down. Now, when they returned, that caused that spike because you had the normal net migration plus ones people coming back. We're back into that normal range at the moment, but that's 300,000 to 400,000 people every year. And in fact, 445 for 2024. And total population 27.4 million. And that net migration is they've all got to be housed somewhere. So the biggest two places, or where the fastest growth, I should say, is in WA. 2.8% growth, Victoria 2.4% growth. That's often a pattern. Those two places lead. Sydney's never far behind, and Queensland and WA pick up interstate immigration, so people move eventually. So that's going to keep driving these prices, and you'll see that particularly in places like Melbourne, which is starting to show some signs of life. In terms of interest rates, we saw that drop of 0.25%. So all of a sudden we got down to 6.4 on the averages. You shouldn't be paying that, by the way. As we said, you should be about 5.7. These are just the average rates that the banks charge. And keep in mind, a lot of the times they'll keep charging you older rates until you complain and either get them to review it or refinance if you need to. Yell out if you need some ammo there, or if you'd like to talk to one of our loan contacts about refinancing if your provider's not looking after you. But rates down is good news for most. Property cycle, performance property clock on the left, and we can see there's no significant changes to last month. We can see, as we talked about, Melbourne's coming that zone where it looks incredible value. It may not get that momentum to start going up till a few things become more clear about its economy and some of the issues with their government deficits down there. But we would fully expect in the normal course of a cycle for that to come back, and Melbourne should be pretty good. Not much change in the Heron Todd White one as well, although they've got Sydney at the start of recovery there, which is different to performance property. These are just analogies. I never credit any one style or guru as being the only one to have an opinion, and we like to take into account a lot of opinions. We do use performance property to help our clients buy investment properties when needed, and they've proven to be very useful, and great track record with that. That's it as I sum up. So as always, with our key principles, and investing best done as part of a real plan, which is based on your goals, your situation, portfolio designed to meet those goals. We do take a long-term view where we can get down to the stuff that we know works in the long run. That's diversification, asset allocation, getting that done smartly, and liquidity, access that at a low-cost index for most, unless there's a good reason not to. And then we protect against that short-term volatility with our reserves for our retired clients, dollar cost averaging for our growth clients, And the education also as well is a protection against volatility. The fact that we talk about this all the time makes our clients less likely to panic. And the rebalancing is the secret soldier of investing and really makes a difference. And as always, there's only 3 ways to lose money. And I know I'm preaching to the converted here. But for the rest of you that, it's panic and selling, it's having to sell and not properly diversified. And, part of that not properly diversified is not having confidence in your investments. So if you know of people that don't have the confidence that you have in your investments, we're always happy to talk to them, because we do know that when our clients have confidence in their investments, in the process, etc., they don't do the silly things that most people do. Thank you as always for listening, and I look forward to talking again next month and seeing some of you in the next month to come.